Welcome to Askprep, your trusted companion for UPSC and IAS preparation. Today, we are delving into an important topic in Indian economics, which is what are demand deposits and their examples. Understanding demand deposits is crucial for grasping how modern banking systems operate and provide liquidity for daily transactions. Demand deposits play a vital role in ensuring financial stability by offering instant access to funds. They are indispensable for both individuals and businesses, facilitating seamless transactions and promoting economic activity. For UPSC aspirants, this topic intersects with key areas like financial systems, banking structure, and monetary policies. So, without further delay, let's get started this essential concept step by step and explore its features, examples, and significance. What are demand deposits? Demand deposits are bank accounts that allow customers to deposit money and withdraw it on demand without any prior notice or penalties. They are widely used for daily transactions because of their accessibility and liquidity. Unlike fixed or term deposits, demand deposits do not have a fixed tenure, and funds can be accessed at any time, making them highly versatile for both individuals and businesses. Due to their flexible nature, demand deposits generally offer low or no interest rates compared to term deposits or savings instruments. Key features of demand deposits: liquidity. One of the most significant advantages of demand deposits is their liquidity. Account holders can access their funds instantly via checks, debit cards, ATMs, or online banking platforms. This makes demand deposits an ideal choice for managing day-to-day expenses and emergencies. No maturity period. Unlike fixed deposits or recurring deposits, demand deposits do not have a maturity period. This means account holders are not bound by time restrictions and can use their funds whenever needed without penalties. Lower interest rates. Demand deposits typically offer minimal interest rates, as the main focus is on accessibility and liquidity rather than savings. For example, savings accounts offer modest interest, while current accounts often earn no interest at all. Examples of demand deposits: savings accounts. Savings accounts are one of the most common types of demand deposits. They are designed for individuals to save money while maintaining the ability to withdraw funds when needed. Savings accounts often offer a small interest rate, making them a combination of liquidity and basic savings. Current accounts. Current accounts are primarily used by businesses, professionals, and organizations that require frequent and large transactions. These accounts offer features like unlimited withdrawals and deposits but generally do not earn any interest. Checking accounts. Internationally, in many countries, checking accounts serve as the equivalent of savings or current accounts. They allow individuals to write checks, make transfers, and conduct everyday financial activities seamlessly. Digital wallets linked to bank accounts. Modern digital wallets like Google Pay, Paytm, or Apple Pay that are linked to bank accounts can act as demand deposit accounts. Users can access their funds instantly and make payments directly from their bank accounts. Importance of demand deposits: facilitate daily transactions. Demand deposits are essential for managing everyday financial activities, such as paying bills, shopping, or transferring money. For businesses, they simplify cash flow management by allowing immediate access to funds for operational needs. Enhance liquidity. The instant availability of funds ensures that individuals and businesses have the financial flexibility to address urgent requirements, whether it's an emergency expense or a sudden business opportunity. Support digital and cashless transactions. In today's digital era, demand deposits form the backbone of cashless transactions. They enable online banking, UPI payments, debit card transactions, and other electronic payment methods, contributing to the growth of a digital economy. Encourage financial discipline. Savings accounts, a type of demand deposit, encourage individuals to save money while offering the convenience of access. This dual benefit promotes financial discipline without sacrificing liquidity. Ease of access for businesses. Current accounts, a form of demand deposit, provide businesses with the flexibility to handle high transaction volumes, supporting their operational efficiency. Insights on demand deposits. Role in financial inclusion. demand deposits contribute significantly to financial inclusion by providing individuals, especially in rural or underprivileged areas, access to formal banking systems. This is achieved through initiatives like zero-balance savings accounts under schemes such as Jan Dhan Yojana in India. Tax implications: demand deposits are subject to regulatory scrutiny. High-value transactions through such accounts can trigger tax audits or reporting, ensuring better compliance with financial regulations. Digital transformation impact: the advent of internet banking and mobile applications has revolutionized the accessibility of demand deposits. Customers can now manage their accounts, initiate payments, or transfer funds instantly from anywhere. Global perspective: the concept of demand deposits is universally accepted and forms a foundation for banking systems worldwide. However, the penetration and use of demand deposits vary significantly between developed and developing economies, largely due to differences in digital infrastructure. Impact on money supply: demand deposits are a critical component of the money supply, specifically in the M1 and M2 measures. Any fluctuation in these deposits affects the liquidity available in the economy, influencing inflation and interest rates. Dependence on economic activity: the volume of demand deposits often reflects the level of economic activity. A growing economy with robust consumer spending tends to see higher demand deposits due to increased transactions. Security measures: with rising cases of cyber fraud, demand deposit accounts now come with advanced security protocols like two-factor authentication, biometric verification, and fraud alerts, ensuring customer safety. Cross-border transactions: demand deposit accounts are increasingly being used for international payments, facilitated by global banking systems like SWIFT and fintech platforms. Impact of interest rates: central banks' decisions on interest rates indirectly influence demand deposits. Lower interest rates often encourage people to keep funds in demand deposit accounts instead of locking them in fixed deposits or other instruments. Relationship with payment systems: demand deposits are integrated into real-time payment systems like RTGS, NEFT, and IMPS in India, ensuring fast and secure transfers without delays. Encouragement of cashless economy: governments worldwide, including India's push for Digital India, encourage demand deposits as a tool to reduce reliance on physical cash and promote a cashless ecosystem. Behavioral aspect: people prefer demand deposits due to their convenience, but excessive dependence on such accounts for savings might limit wealth generation, as these accounts typically earn lower interest compared to fixed deposits or investments. Link to credit and overdraft: demand deposits serve as a base for availing overdraft facilities or short-term credit, especially for businesses that need immediate liquidity without formal loan applications. Money market instruments and demand deposits: money market instruments, such as treasury bills, repurchase agreements, repos, and certificates of deposit, are often tied to demand deposits. These instruments are short-term investments that banks use to manage liquidity. They are an essential component of the financial ecosystem where demand deposits play a key role in the functioning of money markets. Interest on demand deposits varies by country. In many countries, interest rates on demand deposit accounts are quite low or non-existent. However, in some countries or regions, banks may offer interest-bearing demand deposit accounts or encourage higher balances by providing modest interest. Understanding this variation is crucial, especially when analyzing the competitive banking environment. Bank failures and demand deposits: when a bank fails, demand depositors are usually the first to be affected, as they have the right to withdraw their funds immediately. However, government-backed deposit insurance schemes, like FDIC in the US or DICOG in India, protect small depositors, ensuring that their deposits up to a certain limit are safe even in the event of a bank failure. Technological integration and smart banking: demand deposit accounts are at the core of technological innovations in banking, such as smart banking, AI-based banking apps, and biometric-based verification. These technologies make managing demand deposits more efficient, allowing users to easily access their funds, monitor spending, and make instant transactions. Economic cycle and demand deposits: during periods of economic boom, the volume of demand deposits may increase due to heightened consumer confidence, higher income levels, and greater business activity. Conversely, during recessions or economic slowdowns, demand deposits may decrease as people and businesses become more cautious about spending and saving. Consumer behavior and demand deposits. The way consumers manage their demand deposit accounts is evolving. For instance, customers are now more likely to use online banking services to monitor and control their spending. Behavioral factors, such as a preference for liquidity and flexibility, influence how much consumers keep in demand deposits versus other savings or investment accounts. Risk of bank runs. In the event of a financial crisis or panic, customers may rush to withdraw their demand deposits, fearing that their bank may not have sufficient reserves to meet withdrawal demands. Such events, known as a bank run, can severely impact the liquidity of a bank and may require intervention by the central bank to maintain financial stability. Integration with peer-to-peer lending. Demand deposits are increasingly integrated with peer-to-peer, P2P, lending platforms. By linking their deposit accounts to P2P lending networks, individuals can lend their demand deposits to others in exchange for interest. This trend is gradually reshaping how people use demand deposits and access credit. Central bank digital currency, CBDC, and demand deposits. Central banks around the world are exploring the idea of digital currencies issued by the state, known as CBDCs. These digital currencies could become integrated into demand deposit accounts, offering new ways for governments to control the money supply, manage monetary policy, and engage in direct transfers to individuals. These additional points demonstrate the broader, more interconnected role that demand deposits play in the modern financial system, impacting everything from consumer behavior to global trade and government policy. Conclusion. Demand deposits are a cornerstone of the banking system, offering flexibility, liquidity, and convenience. They are indispensable for individuals and businesses alike, enabling smooth daily transactions, supporting economic activity, and fostering financial inclusion. By understanding the features, examples, and importance of demand deposits, one can appreciate their role in modern financial systems and their contribution to a dynamic economy. At Askprep, we aim to bring such insights to help you prepare better for your UPSC and IAS examinations. Thank you. This is Askprep, your guide to mastering UPSC and IAS preparation. Let's decode complex topics and simplify your journey to success.